Hi, let us have a quick revision of Accounting Standard 13 Investment Accounting. Okay, yeah. Before going to this, see, these are my accounting standards book. This is first one, Accounting Standards Made Easy for IPCC, that is CA Inter. This is Auditing and Assurance Made Easy. This is for CA Inter, 100% audit syllabus. And this is IND AS Made Easy. It covers all the standards and it is for CA final. Okay, let us come to our standard, that is Accounting Standard 13 Investment Accounting. Yeah, see, this standard talks about how to account for when you purchase an investment, when you sell it, when you classify, what are the conditions to classify, when there is a change in classification, such items it is discussing. This standard does not discuss about income from investment like dividend, rentals or interest, such incomes, how to account for. No, it is not going to be dealing with. At the same time, investments made by a bank, mutual fund, insurance, venture capital organization, AMC, that is asset management companies. No, if investments made by these entities, they are not governed by Accounting Standard 13. At the same time, investment in finance lease, no, it is not dealt, because it is dealt by Accounting Standard 19. Investments made by employee benefit plan like a gratuity fund makes its investment, no, that is also not dealt by my standard, because this accounting is dealt by Accounting Standard 15. Okay, what is investment? Investment is an asset held for earning income by way of interest, dividend, royalty, capital appreciation and rentals, etc., but not held for sale. Just observe the definition. It is held for means the intention, the purpose of it. I purchase one asset, held for, correct. Now I purchase this laptop, I want to use laptop and I want to provide services to students and earn income, then that laptop is going to be my fixed asset. Got my point? But here it is held for. Suppose I buy the laptops, I sell the laptops, that is held for sale, then it is inventory. That's why read the definition carefully. From the definition you can make out purpose is important for the classification of asset. So here when can you say an asset is an investment to us? Asset investment is an asset which is held for earning income by way of interest, rent, royalty, capital appreciation and etc., but not held for sale in the ordinary course of business. Okay, right. Now with respect to recognition and measurement, yeah, that is first, it is classified further into two. One is initial recognition, the next one is subsequent accounting or subsequent measurement. With respect to initial recognition, let us first finish initial recognition. What do you mean by initial recognition? Initial recognition is recognition at the date of acquisition, first day when you buy, how to record it. Yeah, see, as per the standard, first time when you buy any kind of investment, irrespective of its classification, on the date of acquisition, we need not bother about classification. That means, is it current investment or long-term investment, is not at all to be considered. All investments acquired should be recognized at cost. Okay, right. How can you acquire? We can acquire in any of these three ways. That is, one, by giving cash or credit, okay, or by transfer of securities or barter system. In case if you purchase by giving cash or getting it on credit basis, then what is that? Either basic cost, brokerage or registration cost, legal expenditure. Okay, right. And what is that? Accounting Standard 16, that is interest cost, also can be capitalized subject to if that investment is a qualifying asset as per 16. All other expenses which are directly attributable to acquisition of investment should be added. Okay, if you are buying an investment by issuing a security, suppose I purchased some gold by issuing our company shares, right? Then what is that should be considered? the investment should be accounted for what amount, that is the fair value of the securities issued. Remember, fair value, not face value. Okay, market rate is what? R rate prakara, that's you are supposed to record it. Okay, right. And when it comes to barter system, yeah, barter, as you know, you are giving one asset and you are getting an investment. Under this circumstance, it should be recorded at fair value, what they say, that is fair market value of the asset given or fair market value of the asset received, whichever is clearly evident. Clearly evident means whichever can be measurable clearly, which value I know better clarity I have in measurement, then you should take that value as a consideration for acquisition of investment. Okay, right. And with respect to subsequent accounting, what do you mean by subsequent accounting? This is an accounting on the date of balance sheet. On the date of balance sheet, this accounting requires, this is based on basically on classification. That means on the balance sheet date, an investment needs to be classified either into current investment or long-term investment. Okay, but what is the definition for long-term investment? Straight and simple. What is long-term? Which is not current. So what is current investment? To say an investment is current investment, actually there are two conditions to satisfy. The first one is it should be readily realizable. That means easily convertible into cash. And the second condition, intention to hold for not more than 12 months. If you satisfy both the conditions, then I say it is a current investment. Not just 12 months criteria, it should be readily realizable. Say example, I purchased land and building as an investment for investment purpose. Correct. Now, even though my intention is like I would like to sell it within 6 months, still even though my intention is to sell within 6 months, that is less than 12 months, still I cannot classify the land and building as current investment. The reason, it does not satisfy my first condition of readily realizable. Land and building cannot be said as readily realizable. That's why investment in land and building is always a long-term investment. Okay, right. And again, one more point, investment in land and building is always called as investment property. It is called as investment property. Investment in land and building is called as investment property. Investment property accounting initially recorded at cost, but subsequent accounting, it is you are supposed to follow accounting standard 10. Cost model is supposed to be used. That you will understand in that quick revision lesson. Okay, right. If it is a current investment, then it should be valued at cost or fair market value, whichever is lower. It is fair market value, it is not net realizable value. And because of this, if there is any loss, that should be transferred to P&L statement. Okay, right. And with respect to long-term investment should be always measured at cost, except a situation where, right, if there is a permanent diminution in value, like not temporary, the standard says permanent diminution in value can say, right, in case, then you are supposed to reduce that permanent diminution. Okay, if it is a temporary fluctuation in the market, that need not be considered. It should be measured at cost. Okay, right. And with respect to, okay, if I sell the investment, there are some more small topics are there. If you sell the investment, so you have to determine profit or loss on sale. Whatever the profit or loss, that should be always transferred to P&L statement. It should not go to any capital reserve or any other reserve. It is not as per the standard. Okay, it should always go to P&L statement. How do you determine profit or loss? That is sale proceeds, that is net sale proceeds. That means whatever you got it after paying brokerage or anything, net proceeds what you got it minus average cost. Okay, you remember average cost of investment, but not FIFO basis or LIFO basis. No basis, it is only average cost is supposed to be applied for. Okay, at the same time, next small topic, bonus shares. When the company receives bonus shares from the other company, when our entity receives bonus shares, see, bonus shares means it is received by company at free of cost. Correct. It is received at free of cost. So initially when I got it, that is at cost. At cost is equal to 0. That's why no journal entry is required. But our number of shares earlier, say 1000 we had. Correct. Now 1:1 ratio we got bonus. That means now it became 2000. That's why we just go and adjust the number of shares but not the amount. Okay. Rights issue. When it comes to rights issue, right is an option. It can be exercised by the existing shareholder. If he exercises, that means he has to pay that money to the company and get the shares from the respective company. Yes, whatever you have paid, that is what your cost. Correct? That's it. That is what rights is. Suppose when you got the rights entitlement, I can exercise it and I can sell it to someone else. So right entitlement came to me free of cost from the company. That is received by me because I was already a shareholder on the date of declaration of rights. Okay, right. And if I sell it to somebody for some money, that proceeds are nothing but income. Correct. Now that should be transferred to P&L statement. Okay, next one more small topic with respect to income from investment. When this concept like income from investment, incomes are divided into two kinds, that is pre-acquisition income, post-acquisition income. What is pre-acquisition? Yeah, it is an income. It is an income related to before the date of acquisition. It may be received by us, but it is related to, remember the word, it is related to before the date of acquisition, then it is pre-acquisition income. What is post-acquisition income? It is an income which is related to a period which is coming after the date of acquisition. That, okay, if it is pre-acquisition income, it should be reduced from the investment, cost of investment. So the journal entry would be cash account debit to investment. It is understood that what I paid is what is received as an income. Okay, that's why it should not, this is not earned income. This is what a capital receipt kind. That's why it is reduced from the investment account. If it is post-acquisition income, it should be transferred to P&L as usual. That is one small concept. And as you have classified some investments as current investment or long-term investment, in the after subsequent time there can be a change in classification. This may be due to change in the intention, due to change in the situations. You may reclassify, you may change. Reclassification means change in classification. So what can I have? I have only two, that is current investment, long-term investment. So current can become long-term, long-term can become current. Correct. So when current investment becomes long-term investment, on the date of reclassification, current investment should be first measured at cost or FMV, whichever is lower. Whatever is the result comes now, that is going to be taken as that result amount will be taken as cost for the long-term investment. Remember, it is not the original cost. It is the cost on that. It is the result of cost or FMV, whichever is lower on the date of reclassification. Okay. So in the same fashion, if it was long-term investment and it's going to be reclassified as current investment, in this circumstance, yeah, on the date of reclassification, you should look at what is the book value, that is the carrying amount, or cost, whichever is lower. A lower amount, correct? A lower amount will become the cost for the next classification, that is current investment. Since it is a current investment, on the balance sheet date, as usual, it will be compared the cost with fair market value, whichever is lower only is going to be taken. Okay, right. That's it, my dear. This is the quick revision of accounting standard 13. Thank you.